Welcome to TMS Insights. It's towards the end of May 2019. Jeremy Hook and Ben Clark bringing you an update. And we've had quite a bit going on, some macro stuff and some stuff with our stocks as well. So let's talk about the big one, which was the federal election Saturday. Surprising result. We were absolutely over the moon, Ben.
Yeah, it was. I couldn't have been more surprised, but it was one of the best surprises I've had in a while. So it removes a number of real concerns and uncertainties that we had going into the next few years. It's a huge win for clients versus what the laws were going to change to. So it's a win-win, and it's great news.
Yeah, terrific. So that was great. News always comes, generally speaking. The big happy bits aren't like that, so it's great. So we know a lot of people were worried about that, and that's relieved them. Now, but there's been some other economic news of real importance this week. So we've been talking interest rate cuts in a potentially slowing economy environment for a while, but the governor of the Reserve Bank more or less locked in a June cut, didn't he, this week?
Right, and so this is, the bond market has accurately called this, as opposed to about a year ago when it was saying rates were going to go up. But it looks like we will get a rate cut in June. Some economists are saying we might get 3 before the end of the year, but I think 2 is a near certainty now. And the Australian 10-year bond yield has gone under 1.6% this morning, so that is the lowest it has ever traded at, and reflects our forward outlook that we're going to be in a very low interest rate environment for a very long period of time. We've also had APRA as the other big thing.
Deal because so they've been asking banks to price the rate at which they lend to borrowers at 7% for some time now, and they've actually abandoned that in favour of a 2.5% margin. Right,
which is going to mean, I believe, on the average mortgage in Sydney, that people will be able to borrow an extra $80,000. So I think we might be seeing the end of this pullback in the property market. It's not going to sort of bounce back, but with falling rates and a loosening credit environment, we might start to see a turn in the property market. And, there's quite a lot of stocks on the Australian market that are going to benefit from that as well. Pick up that sentiment.
So the aggregate of the news in the last week, the APRA announcement, the RBA locking in a rate cut, and the return of a coalition government are all very good macro things which have helped the market at the start of the week. And the biggest winners at the start of the week were the bank stocks, which reported only a few weeks ago, and we haven't updated everybody about that. There wasn't a lot to celebrate in the bank results, but those 3 bits of news are great bits for the bank stock.
Looking out forward, it's these things are all going back in their favour. Although I would say the experience in other countries in Europe and America, when interest rates have got to these extreme lows, it's put a lot of pressure on margins because banks don't, what they're taking in as term deposits versus what they're lending in, that does get crunched a bit. So, but still, it's a net, it's a positive for the banks.
Net positive. And obviously the big win, the franking credits from an investor point of view, put them in focus, and they were big improvers over the first couple of days post-election, weren't they? So, but in their results, we tended to favour the Macquarie result over the NAB, ANZ and Westpac results, Ben. That Macquarie has some levers it can pull that are pretty impressive, aren't they?
Absolutely. I think it's amazing how often the market forgets that Macquarie under-promise and over-deliver. So at the start of their last financial year, they guided for 5 to 10% earnings growth. They finished at 17. So blew away the initial guidance. They've then come out with the result and guided low again, which I think in another year we'll look back on and say that was conservative. So the dip in the share price, plus it has gone ex-dividend, looks to me like a good buying opportunity. If you look at the 3 other banks that reported, their earnings were down sort of anywhere between 3 and 10%. And NAB cut its dividend. So to me, these stocks are actually trading on quite similar PEs, and one's growing and 3 is still sort of battling.
So Macquarie's really our preferred there. And
absolutely.
Still buy that. It's ex-dividend. They're all ex-dividend, but it's pulled back and looks okay. So, and it didn't bounce really at the start of the week like the retail banks did.
No, which makes sense because it really has very little exposure to the Australian economy now. And, more than 3/4 of its earnings come from offshore. And we saw them recently in the US and, really impressed with what's going on over there, the quality of the people, It's just the message you get is very different from what we hear. The retail banks are just trying to find ways to cut costs and get some revenue growth.
Well, they're defending market share, aren't they? Whereas Macquarie's actually growing.
Attacking it, yeah.
That's it, and that's growth, and that is beyond these one-offs post-election, etc. The market will reward earnings growth. It always will. So that's good. Now let's talk about a couple of stocks. One that wasn't good news was Reliance Worldwide, great Australian company going out to the rest of the world, special plumbing fittings of the shark bite product, but a profit warning and sold down a bit, Ben.
Yeah, so they downgraded earnings guidance by about 7%. Now, in their earnings guidance, they build in a mild freeze event in the US, which is their biggest geographical region these days. We've had a very mild winter, which has now passed in America, and the bulk of the downgrade was due to that. So it's not something I think we need to be overly concerned by. Reliance is effectively disrupting the plumbing industry in America, and it's making real inroads there. But you're going to have one-off factors like this year to year.
It does, yeah.
It does. And
so they're trading in the 370 sort of region.
380, yeah.
And we'd value them well higher than that.
Absolutely.
So
I would say probably, I've made the mistake in the past of buying companies after a downgrade. You can mask issues in a business by blaming it on something.
Yeah, sure.
So
weather's a typical example.
Weather's an example. So waiting through to August, getting some comfort that those numbers are going to be hit, and then what's the guidance for the year ahead, and then probably re-looking at it again.
Now, another one which is actually taken off is Xero. Now, that was one we spoke about, and you called actually in the January TMS Insight. So these videos certainly got some value, but they hit $60 last week.
Yeah, amazing.
Really good.
So
and growing very rapidly.
Incredible numbers. So this is, the growth in the UK in particular is as they are moving on to an electronic tax system. Growth in Australia as we roll out electronic payroll returns. But Xero is really becoming a dominant global player, and it's finding a lot of adjacencies that it's making a lot more money in, and some interesting sort of graphs in there about, I think it signed on sort of 800,000 new customers in the last year. It loses about $500 per customer in the first year, breaks even the second, but in about 5 years' time, it'll make about $2,000 per customer, and that's proven. So there's sort of growth locked in.
And they hit profit in the second half, which was great. So people have looked at this company and said, well, it's not profitable. Well, it actually was in that second half.
Yeah, and it could be much more profitable if it chose to take off. And this is the argument with these high PE stocks is, people saying, they're very expensive, but misunderstanding the investment that's going on within them that makes them look more expensive than they are.
And that's not a bad segue into that chat. So we went to the Berkshire Hathaway AGM in Omaha, Nebraska, Ben and I, a couple of weeks ago. And it was fascinating to hear from Warren Buffett and Charlie Munger, who are in their later years and have always been value investors. And apart from getting great confidence in Berkshire Hathaway, which we think is very investable now and is a great long-term hold for clients, but some of their comments about buying stocks like Amazon and their comments about Google, which don't stack up against value metrics that they've always used, was really revealing, wasn't it?
Probably the biggest thing we took out of it was that the world's greatest value investors have started investing in expensive shares. But again, their argument is if you look at the investment in these companies, I think, Bill Gates is on the board of Berkshire. Tim Cook
was in the room in the AGM. Yeah.
Apple is now Berkshire's largest holding. And there's some younger, in their 50s, but younger guys coming up. And I think Warren and Charlie have admitted that they missed this, that they got it wrong in terms of thinking it was a fad, and now they are investing in these businesses. They spent over $1 billion on Amazon shares last quarter.
That's right. And, in collaborating that to Paul Bassett, who started Seek, who we follow his work and all of that, asked people just last week, if you had to hold a stock for 20 years, which stock would it be? One stock, and he said Amazon.
Yeah.
And Charlie and Warren have approved the purchases from Ted Combs and Todd Weschler, who got the insight into these companies. But the numbers going forward on something like Amazon are impressive. They're not that expensive, which we would have thought. And if they've rubber stamped it, we should be looking at this space and we'll be talking to clients about this.
I mean, I think we went to a tech conference as well. It's actually the biggest tech conference in America. And the size and scale of it is just extraordinary. And I think the thing we both left with, because Amazon and Google presented at it, thinking was these data storage businesses are they're only just starting.
That's right.
A lot of businesses are still not uploading their data to the cloud, and there's going to be a lot more businesses over the years. So it's kind of growth on growth, and the AWS business within Amazon is probably the crown jewel these days,
business, isn't it?
and it got a lot further.
Truly global.
Yeah.
Where some of their businesses are massive in the States, like Prime, and it won't be here in the same way for a long time, maybe. So,
and if you on Xero's result call, who's hosting all their data? AWS.
Amazing. We'll just bring it back to here and now. So we've had the bank results. We go into what is often a season where we get some profit updates in the June period and end of financial year stuff. So for end of year planning for clients is something we'll be talking about. And Ben, on the stock watch, what do you think now?
Yeah, well, Aristocrat's also just reported today, and that's probably, that's had a great result. The land sales have been very strong, which is effectively the machine sales. But again, it's this move to online where they're moving to online gaming that is really starting. The numbers are starting to come through. So I still think in the growth area, that's one stock that looks reasonably cheap versus the growth that it's delivering. But we're in this sort of, other than that, I just wanted to get that one, but other than that, we're in this confession session now, which we haven't seen too many.
You get some at some stage through June, that's typical. But the market is, of course, it's hit this week, 11-year highs, only about 4% away from record highs. So there's some good news around. We'll be watching things and keeping up to date with it all and bring you an update again from TMS Insights in June.